This is the perfect 3-fund ETF portfolio. It's going to be made of a core position for stability, a growth position to push your long-term performance to the moon, and a value position to allow you to build an income-generating portfolio that pays you dividends no matter what the market is doing. And like always, I'm also going to give you a European alternative if you're European. So, if you're ready, sit back, relax, and let's get right to the video. What's up everyone, I'm Rick, your favorite Italian investor and twin of Mano Ginobili, and if you haven't done it, listen to Trump when he says,
"Guys, let's make Rick Austin's channel great again."
So subscribe to the channel, and now let's move right into the first ETF, which is going to take 40% of the portfolio cake. This ETF is the best ETF you can ever possess, and it's going to be there as a core position to give you a portfolio stability and diversification. Yes, because while the best performing ETFs are like your friends that you go party with, and dividend ETFs are the ones you can come to when you need a quiet talk, the core ETF is like that friend that is always there for you every day, in good and in bad. So the core position must be made in a way that it's not too risky, is diversified, grows substantially over time, and above all, is never going to give you a shock, no matter what the market is doing. The only way, and I mean it, the only way for an ETF to be a perfect core position is that it's broadly diversified, it's not focused on one or few sectors, and it embraces a whole economy so that no matter if some sectors have a crisis, the whole economy is going to balance it, and the country in the long term is always going to grow. That's why for the first position I chose VOO, the Vanguard S&P 500 ETF, which is the biggest ETF in the world for assets under management. And I can't help but mention it in almost every video of mine because this ETF can't be missed in any respectable portfolio. VOO contains the largest 500 publicly traded companies in the US equity market, weighted by market cap and other factors. When you own it, you're going to get the top of the American economy, without sector racism, because all sectors are represented based on their performance and their weight. And obviously, all famous companies that you can think of are inside this ETF. Apple, Nvidia, Microsoft, Amazon, Meta, Google, Tesla, I mean all of them. Now, you might wonder why I haven't chosen VTI here, which is the total stock market from Vanguard. VTI holds not 500 but over 3,600 companies, namely all publicly traded companies in the US. So, if I want diversification and stability, why not just go for the total stock market? The reason is that the S&P 500 automatically takes in the best of the economy. And it constantly does it by rebalancing every year. So it's like you have a talent scout that every year, without you doing any work, chooses the best people for your company. Now, I need to make it clear. No matter if you buy VO or VTI, the result is going to be pretty much the same. I have graphed here VFINX and VTSMX, which are the oldest Vanguard indexes of the S&P 500 and the total stock market from 1992 to 2020, just to give you an idea of how close these two ETFs perform. And honestly, whatever we say then about VTI being better because it also includes small cap, or VO being better because it doesn't include small cap, is just speculation. Now, for European investors, you're going to find the S&P 500 from Vanguard as ticker VUAA with 0.07% expense ratio, or from Invesco with 0.05% expense ratio. The Spider or SPDR is also available with ticker SPYL and an expense ratio of 0.03%. Only I noticed that the spread is a little higher than the other two, so I would go for the first two. Now, before moving to the next ETFs, let's play a little game together. Let's say that you make a budget, you give up a Starbucks coffee every day, maybe you get rid of some subscriptions that were costing you a lot of money but you weren't actually using, you buy groceries in a clever way and you avoid wasting money. And voila, you have $500 a month to invest. Now, let's imagine that you invest this $500 every month at the beginning of the month without being an investing expert, without knowing if the market is going up or down, just DCAing into the market with the same $500 every month. You're starting from scratch, so currently you have $0 invested. You know that with time, your income is going to increase. So you're going to be able to increase your monthly investment amount by, let's say, 5% every year. Let's say you're 30 years old and you're going to retire at 67. Therefore, you have 37 years in front of you. The S&P 500 has given an average yearly return of 10%, which we're going to insert here. And inflation. Let's not forget inflation, because no matter what you do with your money, every year inflation makes your money weaker. And I want my viewers to always hear the whole truth from me and not just a beautiful lie. At least that's what I try to do. After 37 years, you would have almost $4 million. $4 million, adjusted for inflation, meaning take into account the fact that in the future everything is going to be more expensive, and therefore 4 millions in 37 years are not going to be as 4 millions now. Your portfolio at retirement is going to be just as if you had $1.3 million today. That's amazing in my opinion. People spend all their money without ever thinking of investing some of it, and they end up in retirement with nothing except social security and sometimes a paid apartment. You can't imagine how easy you can build a nest egg that you can use in the future to help your kids, maybe pay for their college or help them when you're gonna have grandkids, or make a beautiful holiday every year with your family, or whatever beautiful things you can do when you have the money to do it. And if you believe that saving money aside is impossible for you, just drop me an email and let's talk. I'm sure I can help you with your budget and find out where you can save money here and there so that you can invest it. The next ETF in my 3-fund portfolio is the one that is going to give a push to your portfolio performance. Yes, because this ETF must be an ETF that chooses only the best of the best performing companies in the world. Companies that are hungry for growth, invest all their money into getting better in the long term, and belong to the strongest growing sectors of our millennium. In this 3-fund portfolio, this ETF is going to have 30% of the weight. But remember that you are free to choose the weight of these ETFs based on your needs. The ETF I'm giving you today is the best growth ETF ever created. It has existed for more than 20 years and it's in the top 5 of the biggest ETFs of the world per assets under management, preceded only by S&P 500 ETFs or by the total stock market. What are you getting with it? You're getting access to the top 100 growth companies in the Nasdaq Composite Index. Everything you can think about when you picture the future. So imagine one ETF that not only captures the best of the information technology sector, but also gets you the best, most disruptive companies of all the other sectors. The reason why I'm adding a growth ETF to the portfolio, by the way, is not that these companies are not represented in the core position. In fact, VO actually has everything you need. But a growth ETF is what you use if you want to force a higher performance and you want to have control over how much growth you want in your portfolio. If you haven't guessed, I'm talking about the Invesco QQQ Trust Series 1 ETF, ticker QQQ, which not only had a staggering average growth of 18% per year in the past 10 years, but right now, because of the crash caused by Trump's tariffs, is even on sale at a discount. QQQ has an expense ratio of 0.2%. And his little brother, QQQM, is exactly identical but with 0.15% expense ratio. You're free to choose between them, they're exactly the same, and obviously QQQM has the advantage of the lower expense ratio. QQQ has outperformed the S&P 500 both in the last 5 years and in the last 10 years, and since inception in 1999 generated an average yearly return of 9.57%, which is enormous considering that the decade right after QQQ inception has been one of the worst decades in history, with a growth of almost zero. If you are a European or British investor and you want to invest in QQQ or in general in a growth ETF, you can invest in EQQQ, the Invesco Nasdaq 100, that has an expense ratio of 0.3%, or even better, the Lixor Nasdaq 100 from Amundi, ticker LYMS, which brings the expense ratio down to 0.22%. Alright, the third ETF of this portfolio also gets a 30% slice of the cake and is one of the best dividend ETFs in existence. Right now, thanks to Trump, it's selling at a discount, and by the way, it had a quite difficult couple of years so far. In fact, it basically has the same price that it had in May 2021. This might worry some of you, but the truth is that if an ETF has solid fundamentals like this one, a great strategy in selecting the holdings, and didn't have a big growth in the past years, it's due for a strong comeback. The reason why I'm adding a dividend ETF is not because you absolutely need it. Again, let me remind you that even having only the S&P 500 as your only ETF is totally fine. But I'm doing this because then you're going to have a position in your portfolio that is going to give you stable dividends, so stable income. So that's why this ETF is not going to be an ETF that gives 10% dividend yield, but instead it must be an ETF that consistently delivers good dividends and performance. This ETF is the second biggest dividend ETF per assets under management in the whole world. It offers a nice, quite stable 3.7% dividend yield and grew with an astounding 13% per year since inception in 2011. I'm talking about SCHD, the Schwab US Dividend Equity ETF, that for a minimal 0.06% expense ratio gives you access to the 100 best high-yield dividend growth blue chips in America. If you'd invested $10,000 in SCHD 10 years ago, you now have around $29,540, and they would yield you now around $1,000 every single year just in dividends. SHD has returned 8% in the last 12 months, 17.3% per year in the last 5, and 11.4% per year in the last 10. SHD tracks the Dow Jones US Dividend 100 Index. Some criteria like 10 consecutive years of dividend payment, a high market capitalization, high dividend growth over the past 5 years, high free cash flow to total debt, high return on equity, and high expected forward yield. For European investors, I'm sorry, but Europe doesn't offer a wonderful choice for dividend ETFs. You can watch this video of mine where I only talk about dividend ETFs in Europe, or you can choose the Vanguard FTSE All World High Dividend Yield UCITS ETF, the S&P 500 US Dividend Aristocrats, or the MSCI World Quality Dividend ETF. And honestly, not so many others without extremely high expense ratio. If you have some other ideas, please write them down in the comment section below. So, this is the portfolio. 40% VO, 30% QQQM or QQQ, and 30% SHD. If you're interested instead on the perfect portfolio based on your age, experience, and other data, just download my ETF Portfolio Builder that has a tab for American, a tab for Europeans, and a tab for Canadian investors. And here you can set up your data and investing experience, and the tool is going to give you the perfect set of ETFs for you. You can download it for free through the link in the description below, and the only thing I ask you in return is to be nice and drop a beautiful like to this video. So let me know what you think about the 3-fund portfolio in the comment section below, and hey, remember that Trump before told you to subscribe to the channel. So don't make him mad. I wish you a great day everyone, or evening, and as always, I'll see you in the next video. Ciao!